Okay, so here's what just happened this week. The biggest crypto bill in US history just hit a wall because Coinbase literally walked away from the negotiating table. Meanwhile, a new company backed by Ripple and SBI is about to become the largest publicly traded holder of XRP with over $1 billion. And oh yeah, Japan's biggest financial conglomerate just invested in a prime broker doing a $12 billion IPO. Let me break down why all of this is connected and what it actually means for the future of finance. All right, so first up, and honestly, this is the story everyone's been waiting on. The US Market Structure Bill, the Clarity Act, was supposed to get its big Senate vote on January 15th, but then everything fell apart. Let me tell you what actually happened. So, the Senate Banking Committee released a 278-page draft bill on January 12th. And by the deadline, it had attracted 137 proposed amendments. Yeah, 137. That's a lot of people wanting changes, right? But here's where it gets really interesting. On January 14th, Brian Armstrong, the CEO of Coinbase, publicly withdrew his support. And I'm quoting here. He said the bill would be, quote, materially worse than the current status quo, end quote. He literally said they'd rather have no bill than this bill. Now, what's actually in this bill that's so controversial? Well, there's a provision that would ban stablecoins from offering yield. And that's a huge deal because stablecoin rewards make up about 20% of Coinbase's revenue. We're talking $355 million in Q3 alone. And here's the kicker. The banking lobby is arguing that yield-bearing stablecoins could trigger up to $6.6 trillion in deposit outflows from traditional banks. So you've got crypto fighting banks, crypto fighting crypto, and Congress caught in the middle. The Agriculture Committee still has its markup scheduled for January 27th, so this story isn't over. But the dream of a clean, unified bill by Q1? Yeah, that's looking a lot messier now. The Clarity Act's stablecoin yield ban pits crypto exchanges against banks in a $6.6 trillion fight over where Americans keep their money. And the bill's fate now hangs on the Agriculture Committee's January 27th vote. All right, let me switch gears here because this next story, honestly, this might be the most significant XRP development since the SEC lawsuit ended. There's a new company called Evernorth, and they're about to become the largest publicly traded holder of XRP on the planet. So on January 21st, Evernorth Holdings filed a Form 425 with the SEC. This is a required filing when you're doing a SPAC merger and need to communicate with shareholders. Now here's what's happening. Evernorth is merging with Armada Acquisition Corp. 2, which is a SPAC, and they're going to list on NASDAQ under the ticker XRPN. Yeah, XRPN. They're not being subtle about what they're doing. But here's the really interesting part. This isn't an ETF. This is a public company with XRP directly on its balance sheet. They're targeting over $1 billion in funding, with most of that going straight into XRP purchases. And look at who's backing this. SBI Holdings committed $200 million as the anchor investor. Ripple is in, Pantera Capital, Kraken, GSR. These are not small players, right? The CEO is Ashish Birla, who was a longtime Ripple executive. He stepped down from Ripple's board specifically to lead this. So why does this matter? Because for institutions that want XRP exposure but don't want to deal with custody, wallets, or compliance infrastructure, they can just buy shares of XRPN through their normal brokerage. It's basically a backdoor for corporate treasuries to get into XRP. Evernorth represents a new model for institutional crypto exposure, a publicly traded company holding XRP directly. giving corporate treasuries and traditional investors a way to gain exposure through regular equity markets without touching crypto custody. Okay, now let's talk about SBI again, because they're not just backing Evernorth. They just made a $50 million investment into a US prime broker that's about to IPO at a $12 billion valuation. And they're planning a joint venture in Japan. So ClearStreet is a New York-based fintech that started in 2018 as a prime brokerage platform. And their numbers are absolutely insane. For the first 9 months of 2025, they did 783 million in revenue with 157 million in net income. That's up from 300 million revenue and 20 million profit in the same period of 2024. We're talking 160% revenue growth year over year. Now, they just filed for a NASDAQ IPO under the ticker CSIG. Goldman Sachs is leading the underwriting. Bank of America, Morgan Stanley, UBS are all involved. The target valuation is $10 to $12 billion. But here's where SBI comes in. SBI Holdings, which is one of Japan's largest financial conglomerates, just invested 50 million for a minority stake, and they've agreed to pursue a joint venture in Japan. Now, why does Japan need this? Because prime brokerage services in Japan are still dominated by old foreign institutions with limited automation. Smaller hedge funds and high net worth individuals have restricted access. So SBI is basically importing fintech infrastructure to modernize Japanese securities trading. And remember, ClearStreet's platform covers equities, options, futures, foreign exchange, fixed income, and digital assets. So when this joint venture launches, Japanese institutions get access to a unified platform that includes crypto. That's huge. SBI's investment in ClearStreet isn't just about prime brokerage. It's about bringing a unified trading platform that includes digital assets to Japan's institutional market, potentially opening the third largest economy to integrated crypto TradFi infrastructure. All right, for our final section, let's zoom out and look at a new report from River that honestly surprised me. We all talk about not your keys, not your coins, right? But the data tells a different story. So River published their Bitcoin custody report in December 2025, and the headline finding is pretty shocking. More Bitcoin has been lost to self-custody mistakes than has been lost to exchange hacks and collapses. Let me give you the numbers. 1.6 million Bitcoin, valued at over $1.5 billion, has been rendered permanently inaccessible due to self-custody mismanagement. Compare that to 1.2 million Bitcoin lost in exchange incidents like Mt. Gox and FTX. So self-custody losses actually exceed exchange losses. Now, River's methodology looked at wallet inactivity over various time frames. Wallets that have been dormant for over 10 years, excluding Satoshi's coins, represent the largest share of estimated losses. These are people who lost their keys, forgot their passwords, or simply died without proper succession plans. But here's some good context. More than $800 billion worth of Bitcoin is currently held in self-custody successfully, and about half of all Bitcoin on exchanges can now be independently verified through proof of reserves. So what does this mean? Look, self-custody is powerful if you know what you're doing. But for institutions, this data shows exactly why regulated custody solutions and Bitcoin ETFs are seeing massive inflows. Not everyone should be their own bank. River's data reveals that self-custody losses exceed exchange losses, fundamentally challenging the not your keys, not your coins narrative, and explaining why institutions are flooding into regulated custody solutions and ETFs. So look, Here's what ties all of this together. We're watching traditional finance and crypto infrastructure merge in real time, and it's messy. The regulatory fight in Washington shows that banks are scared of stablecoins eating their deposits. $6.6 trillion in potential outflows. That's not competition, that's an existential threat. Meanwhile, SBI is investing across the board. 200 million into Evernorth for XRP, 50 million into Clearstreet for prime brokerage. They're betting that the future of finance runs on blockchain rails, and they're building the infrastructure to prove it. And River's custody data shows us why institutions need proper solutions. Not because crypto is bad, but because key management is genuinely hard. 1.6 million Bitcoin lost forever is a pretty strong argument for regulated custody. The question isn't if traditional finance adopts blockchain. The question is, who builds the bridges? And right now, the answer is companies like Clearstreet, Evernorth, and the banks fighting over stablecoin legislation. If this breakdown helped you understand what's actually happening with institutional crypto adoption, hit that subscribe button. I cover these deep dives every week on the stories that actually move markets. And drop a comment. Which story surprised you most? The regulatory drama or the institutional money moves? I genuinely want to know what you're paying attention to.